Today is April 6th, 3:34 p.m. and we saw some unusual options on Micron Technology. That's ticker symbol MU. And we will show those options that we saw and then propose another trade idea that we did because it takes less capital. And very briefly, just technically, today was a dividend day. And so when the stock actually rallied instead, it's up 3%. That's quite positive for this stock because usually on dividend days, the stocks go down. And also here on the stochastic oscillator, you'll see that it's bouncing off of that oversold condition because of the past few days. We have been going down. And so today it looks like it's bouncing, but let's confirm it with the unusual options activity. And so here we are at 11:47. You'll see here these three options here for 4,440 contracts. And also here, same time, but a different second. It's for 1,455. At the same 11:47 in the morning. So what does this all mean? Well, let's take a look at the options chain here. On July, this is 106 days away. So keep in mind this is pretty far out, medium term out, 100 days out. So we believe that here is the strikes, the 50 here. You'll see the volume here, greater than the open interest, and you'll also see here the 62, also volume greater than the open interest, and then the 72.5 strikes here, also volume greater than the open interest here, all greater, right? So what we believe is going on here is they're buying this 62 and selling the 72.5s, and then also selling the 50 puts. That's bullish also. However, they're using trying to reduce their theta by selling that put. So you could see the profit loss here. This is the analysis of the trade. The y-axis is the profit loss amount, and the prices are on the x-axis. So here we are at $58.64, the price of Micron. And as it goes up, it will profit, and as it goes down, it will be at a loss. However, at that 50 strike, you'll see here, as time goes on, it's actually going to gain in value. So they're minimizing their risk with this this theta, positive theta decay on their 50 put. And so that's what's so in case the price does drop, they will be able to minimize their loss because it will be, as you see, as time goes on, the purple line will start to get closer to the blue line. It'll look more similar to that at expiration date, as you see it getting closer and closer as these options expire. And so and there we are, 7/21 at expiration date, you'll see. And so you'll see now it looks more like that. So once it expires, it's gone. The purple is gone. Okay, and so what are they doing here? We can take a look at the trade. You can see the theta we have to put the date back to today for 6. Okay, and so today, as of now, the theta is positive. It's 0.74, and we have a negative vega, so the volatility will go down, is what they're suspecting, and we have a 46 delta. And so our trade, let me show you that, and here we are, and we can compare that. Our trade is over here. We're taking a much shorter term because we're going to cut our trade off if the direction isn't going to be going in the direction that we think it's going, which is up. and it will be reducing our loss. So what we did was we sold the 59s. We sold 2 of these, and we bought one of the 57s, and we bought one of the 60s. And so that is our trade. It doesn't cost as much. It's just, here it is. Let's turn that off and just turn it on. It's a butterfly. It's a broken wing butterfly. You can see that here. So as the trade goes up, you'll see this is how it looks. It'll start to also mimic that final blue line. Okay. And so why we like this trade is the cost of this trade is very low. While we can still have a negative vega, a positive theta, also a positive delta, right? And so we can adjust how many contracts we want, how much do we want to pay to have the same amount as the unusual options. As we increase this, we are also increasing our deltas, our thetas, and our vegas are getting more negative, which can mimic the trade as the unusual options activity. And so if you were to put on a trade like this trade here, then it will be require a lot more buying power because when they put on this trade here, they have to sell a 50 put, right? And when they sell a 50 put, that's saying they're going to buy 100 shares of Micron for $50. And so that's essentially $5,000 of capital per contract. And so if you don't want to use 5,000 for this trade, then you can use the trade we have if you think it's suitable for your accounts. The cost of this, so since one of these contracts was 5,000, you can kind of tell like how much they put into this trade because they had about 6,000. Well, based on this here, we could see they had 4,450 plus the 1,455, 5,905 contracts, times that by 5,000 buying power. And so they require $29.5 million to put on this trade. It's definitely a large institution. And so that's why we're going to be following this trade, but in a different manner because we don't want to put 5,000 per contract in this. And so we're going with the broken butterfly that mimics the Greeks on that unusual option trade. And the only difference, the main difference is that if it does start to go down, if the price starts to go down, the theta is actually going to be negative for our trade. So that's the main difference, aside from the capital required, because if you look at their trade, as the price goes down, their theta is actually still positive. As I was saying earlier, as it goes down, the theta will push their profit loss upwards. So that's why for them it's lower risk because they have a lot of capital. They have that amount of money to be able to put on these trades, and so that's the advantage of having so much capital, and why there's a tendency these large institutions still have better odds. Okay, so I hope this video was helpful, and if it was, please like and subscribe, hit the bell icon, and you will be notified whenever we see these unusual options. So good luck and have a good Friday tomorrow, and good weekend.